Good morning, everybody. Welcome to today's 1Mby1M Strategy Roundtable for Entrepreneurs. 1Mby1M, as you know, is the first and only global virtual accelerator in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. And in support of that mission, we do these free mentoring roundtables week after week after week. We are pretty much here every week. And this has been going on for over 10 years. We started in the fall of 2008 with some small baby step experiments, and now this is our 435th session. So 100,000 plus people have participated in these, and it's been a, really intense and interesting, exciting journey for us and for entrepreneurs who have participated in the program. The event is being recorded. This and all previous sessions either are or will be available on our 1M1M Roundtables channel on YouTube. It is actually a very interesting body of learning material. We believe in case study-based learning. You don't have to learn by making all the mistakes yourself. It's a good idea to listen to other people, to study, to use all these various resources available online, especially to learn so that you can avoid making the kinds of mistakes that are being repeatedly made in the entrepreneurship universe. So feel free to use this as a learning material, body of learning material. If you are live tweeting the show today, please use hashtag 1M1M. And our Twitter channels are at 1Mby1M and at Romana. We publish a lot of interesting content. Now, these are the call-in instructions. We are not quite ready for you to call into the program, but we will be. After the scheduled programming is over, we'll open up the line, and any of you can call in. This is a roundtable, not a broadcast, so we want you to participate. Meanwhile, while we are not quite ready for you to call in, we are very much ready for you to use the public chat. So be sure to set your public chat to send to all participants, and that gives you access to everybody in the room. So you can chat with anybody and everybody in the room, network, introduce yourselves, weigh in on issues we are discussing. Today, we're going to start the conversation with David Lambert, Managing Director of Right Side Capital. David, welcome to the show.
Hey, thank you so much. It's great to be here.
So tell us about you. Tell us about Right Side. Let's get acquainted.
Okay. Well, really quickly about me. I've predominantly been a career entrepreneur before starting Right Side Capital. So came out to the San Francisco Bay Area to go to school. Went to Stanford, late 80s, early 90s. Month after I graduated, started my first company, and then over the next sort of 16 to 17 years, founded and ran 2 different companies, one a computer hardware company, one sort of a traditional .com software company. And then beginning sort of in 2008, 2009 timeframe, started talking about sort of the seedling of the idea of Right Side Capital with one of my partners, and then we ended up going live and starting investing in 2012. We've got 3 of us now, so by the time we were live, there were 3 partners. All of us really career entrepreneurs, a lot of operational experience. And what we do at Right Side Capital is we're basically a quantitative, data-driven, pre-seed stage investment firm. And I can give you some pretty good ideas of what we invest in. For the most part, we're looking to invest in companies that are looking to raise relatively small rounds of funding, so anywhere between $100,000 to $500,000 as a total round size. We're usually a pretty small check, anywhere between $50,000 and $200,000, but typically $100,000 our most common check size. We're generally looking for companies that are pretty capital efficient and have capital efficient business models. So most of the companies we've invested in have either been bootstrapped or have just raised relatively small amounts of capital by the time we invest in them. We're generally looking for companies that already have a live product, generating a little revenue. Most of what we invest in has about $5,000 per month or higher. We are not necessarily looking for companies that are looking to go down the venture capital channel. So we're fine if you want to go down the venture capital path and you think that's right for you. But I would say that probably 3 out of 4 of the companies that we invest in, at the time that we invest, it's a reasonable assumption that they could get to cash flow positive with 2 or 3 million raised over the life of the company, and not necessarily need to go on the high cash burn, high fundraise, shoot for the moon path. So we're completely fine if you want to do that. We basically invest usually a round or 2 earlier than what you would think of as traditional seed investors, and usually a round earlier than what most other pre-seed investors would do. Our sort of typical round might be a company that's raising just $200,000 or $300,000, and we might be 100,000 of that. We're based in the Bay Area, but we predominantly invest outside of the San Francisco Bay Area and outside of New York City. I would say San Francisco and New York probably makes up 20 to 25% of our portfolio combined, and the rest is in geographies outside of those 2 cities. But we do predominantly invest in North America, so mostly U.S., some Canadian-based startups, occasionally in Mexico.
And what about sectors? Is it a B2B preference? What kind of companies do you like to invest in?
Yeah, so our favorite business model is definitely B2B SaaS. We don't have a particular focus where we have to invest in that, but when it ends up happening in today's world, it takes a lot less capital to build a successful B2B SaaS business than it does to build a consumer business. So that's something that, our mix has changed over time as sort of the capital needs for different business models have changed. I would say back in 2010 to 2012 timeframe, it was probably cheaper to build a consumer product, because if you could get an article written about you on TechCrunch or in some news media, you'd get thousands to tens of thousands of users overnight, and you could sort of test your product, see if people liked and used it. Now you can't do that. And so it's much more expensive, and just most B2C companies don't end up fitting what we're looking for. So we try to keep an open view, because what's capital efficient today might be very different than what is just a year or 3 years from now. So we try not to view ourselves as sector focused. But 70 to 75% of what we invest in today's world does end up being B2B business models, mostly SaaS.
Got it. So did you read my recent series of Bootstrapping to Exit articles? I think I've written several.
Yeah, I have read some of them, and I've listened to some of your previous interviews, so I have a very good idea sort of philosophically where you're going, and we're very much aligned with that. We think, at a high level, we think most entrepreneurs, the entrepreneurial world at a high level has been somewhat brainwashed, we think, by the venture capital world into believing that the rounds of funding you raise and the amounts and who you raise it from and those valuations are what determines success. And in our view, what determines the success is the last check into your company, which is the one where you're being acquired, and everything else is about working backwards towards that.
So let's talk about a few of your companies. Walk us through a few examples of what you have invested in, and in particular, give us some insight into what was the state of the company when they came to you, who were they, how did you find them, and what is it that attracted you enough to want to write the check?
Yeah, so we're very active investors. So we've invested in 900 companies since 2012. So very high volume. I can highlight a couple, but it's not that we have a very specific profile that we're looking for. We have some companies that will be well-known sort of brand names that have gone down the venture capital route. Some of those might be, PillPack, ClassPass, DataRobot, things like that. We've got a lot of companies that will be completely off people's radar because they're going after sort of niche vertical B2B SaaS markets that people don't know about. So, we have a company called Pet Desk that is a B2B SaaS product for the veterinarian market, and they're doing wonderfully, but almost no one's going to have heard of them. We've got a very interesting company called LabFellows that has a B2B SaaS product that targets the life sciences, biotech lab market, and is a product that helps sort of lab operations. but again, not necessarily a market or a product that most individuals will be that familiar with. In general, what we look for in companies is sort of a host of things. We we sort of look at team. We look at how much capital you raised to get to where you're at. We look at what your current cash burn is now. We look at your unit economics and, a host of other things. And we basically suck up a lot of data points, and then we make a very quick yes or no decision, usually in a week or less, and move forward. And what our philosophy is, which is somewhat different from most firms, is we actually think at this early stage, you can't predict much about the future for any company that you're looking at. So we do almost no subjective analysis where we say, is this a good idea or a bad idea? Do we think there'll be demand for this product? How large will this market get? We think that at the stage that we invest in, there's too many variables of uncertainty, and you just really can't be that accurate in making any predictions going forward. And so that step, that big subjective analysis step, doesn't add much value. And that would be in the scenario where companies don't pivot their business models a lot. But the reality is half the companies we invest in that are wildly successful don't look anything like what we invested in originally. So when you add that twist in, we think that subjective analysis doesn't sort of do much. So what we do is we focus a lot more in today's world on unit economics, cash burn, and team, things like that. And, is your price point high enough to support a sales force or not? And sort of, what are your likely cash needs in the near term going forward? And then we protect ourselves. It doesn't de-risk each individual investment that much. Most of what we invest in is going to fail, but we do hundreds and hundreds of investments to sort of smooth out the risk curve at that early stage.
And so what kind of a fund size are you working with to be able to do that many investments?
Yeah, we have our current fund is $15 to $20 million fund. We have sort of $50 million under management over our all of our funds. So relatively small fund sizes to date. First fund was launched in 2012 and was very much a proof of concept fund. But we still did over 250 investments out of that fund.
Have you seen exits?
Yeah, there's been a handful of exits. So, one of the companies I just mentioned, earlier on, PillPack, they were bought by Amazon, for almost $1 billion earlier this year. A lot of companies that have sold to will be companies people haven't heard of. But yeah, one of the things that we're in favor of and don't mind at all is companies selling at lower valuations, sort of exits
lower valuation
don't make the headlines. Anything in the $20 to $100 million range.
Okay, good. As the audience, if you haven't read this article, by the way, the Bootstrapping to Exit article, Maureen will share it in the public chat. You definitely should read it. Most exits happen in the sub 50 million range, strategic exits. So you're going to have to manage your capital into the company to be able to make money for everybody at the sub 50 million range. So I'm happy to hear the range that you gave, 20 to 100 million, is good.
Yeah. Actually, Rightside Capital was founded, sort of based on the knowledge and the data that most of the exits happen at the sub $50 million range. And there's very few once you start getting north of 100 million. So right. Our high-level goal is to build a really diversified portfolio of companies that, at the time that we invest, most of them, are on a path where they could take advantage of that sort of the most active and liquid exit market that's out there, which we view as that low-value M&A market. And then some companies, some smaller subsets, self-select themselves out of that because they believe their business can scale a lot higher, or they just want to go on a higher risk profile for their business, and they end up going down the venture capital path. And we're completely fine with that too. We give intros to VC firms for any companies that want to do that path, but we certainly don't force that.
Can you talk about a couple of examples of these companies that nobody has heard of that have found good exits? That have found ones that no one has heard of that have found good exits.
Sure, I'll give even an example of one that did an interesting pivot and found a good exit. Sort of went forward well, everything fell apart, pivoted, and then everything came back. So one of them was a company called, that goes by Draft now. They had a slightly different name earlier on when we invested, and they were in this is actually one of our consumer ones, but they were in the daily fantasy, sports fantasy world when we invested. And this was sort of before the government in the U.S. had a lot of the states had tried to shut that market down. They had bootstrapped and off of almost no money become the 6th or 7th largest player in that space. We invested in a small round that they did. They grew successfully, and then you had 2 large players in that market that came in and raised hundreds of millions in venture capital, bludgeoned each other to death, and pretty much killed off everyone else in that market. And they sort of saw that path happening, and they ended up selling off the assets they had built to one of those 2 dominant players, and then they ended up restarting and building out a consumer product that was not based on live betting, that was sort of based on social networks and things like that, started to get traction there. And because they were capital efficient, they were able to stay alive long enough to where that market sort of came back around to being a little more friendly to live betting. They started pivoting back into that, but with a substantially different business model. And then a public company from the UK, where gambling is legal, came in and wanted to enter the U.S. market and made them an offer that was in the mid-tens of millions of dollars range, and they sold rather quickly at that point. And it was a great outcome for the entrepreneurs. And the only reason they were able to execute on that exit is because they had been very capital efficient to date. They had not raised millions and millions of dollars. I think they had raised something along the lines of 2 to 2.5, over their entire lifetime to there. Some other interesting things that happen that you can put yourself in play for as an entrepreneur if you're capital efficient is sometimes feeding into the private equity world as well and getting partial liquidity. So that company that I mentioned, PetDesk, they were also very capital efficient, and they recently had a round, it was like a $12 million round led by a private equity firm, or a firm that it was a venture firm that sort of acted like a private equity firm a little bit in how the round came together. And the company was able to get new capital in to grow the business, but also a substantial amount of that went to buy out some of the existing cap table, and the founders were able to get some liquidity from that exit as well. So we've had a few different companies that have gone down that path and have raised rounds where they got partial liquidity and then get to keep going forward with the business.
So here's a question. You mentioned pivot several times. Pivot is a very tricky thing to manage, and it's a very tricky thing to manage from a cap table point of view, because if you need to raise more capital to support a pivot, that means that your early investors didn't really get a lot of valuation. Nonetheless, that happens, and it happens very regularly. So here's a question that's a slightly more subtle question. I was actually coaching one of our entrepreneurs, one of our premium members, yesterday, and this is a company, it's a SaaS company, B2B SaaS company that has a couple of paying customers, has 3 POCs going right now, but their paying customers or POCs are not in the vertical where they think they're going to build the bulk of their business. So they have, in course of figuring out the product, they have decided that there is a vertical that they want to go after, but the initial traction is not yet there. So, these days seed investors want everything checked out. So would this be the kind of company, they do have some, recurring revenue, a little bit of recurring revenue right now, probably $4,000 or $5,000 a month. Is this the kind of company that would fit your investment thesis from a B2B SaaS point of view?
Potentially. It's on the cusp. It would sort of depend a little bit. That would be at the high level. If they haven't raised a lot of capital to date and they only need a relatively small round, that would be a company that would sort of make it into our front-end screens and that we would look at and dive deeper. One of the mistakes a lot of people make and a lot of entrepreneurs make when they look at our website or they hear me talk, they think, I'm a startup. I've got over $5,000 a month in revenue. I'm looking to raise a round that's below $500,000, I'm looking to do it at $2.5 million, I check everything on your box, therefore you're just going to fund me. Those are sort of like criteria for you to even get in the front door and for us to start to take a look at you, because almost everything we fund fits in that profile. For a company like that, it would really depend. Are those POCs just very short deals where they've got $5K a month revenue, but that's for the next 60 or 90 days, and then that goes away? Or are these sort of ongoing indefinite pilots, where these are companies that are sort of trying it, as a SaaS product ongoing and then they're debating whether to scale out and be much larger. Mm-hmm. If it's that and the price point is fairly high, where we're very convinced, it can definitely support a sales force, then that's probably the profile of a company that we could potentially invest in. Usually, though, we discount POC and pilot revenue. So if they were that same profile and they just had 4,000 or 5,000 in revenue of customers that had gone through pilots and are using it live, we wouldn't care that those customers weren't necessarily in the market that they think is going to be the main market they go after.
They have a couple of customers, but I'm just using this to kind of see how you think about deals. These guys have real revenue from a couple of customers and then more PLPs. But let me probe one point you made is how much capital has gone into a company. Can you elaborate? So for a company to have got to $4,000 or $5,000 MRR, what is comfortable from how much capital has gone into that process?
Yeah, so I'm going to give you my 2019 answer to that, and then maybe I'll give you a little bit of a backstory, because that's changed substantially from 2012 to 2019 as far as what's sort of possible in the entrepreneurial world. So in today's world, I would say, the average company that we're investing in that's got 4 or 5 MRR, has probably raised, $100,000 previously. Mm-hmm. Some small subset of that, which is sort of growing each year, maybe has raised nothing and has just bootstrapped entirely, or just been some founder dollars that have gone in. And I would say for a company at that stage to be a fit for us, it'd probably be a max of about $150,000 that has gone in. Mm-hmm. As you get to some higher numbers, if we're investing in a company that has $25,000 or $30,000 a month in MRR already, then it's a wider range. It can be anywhere from they haven't raised a penny to maybe they've raised up to about 250 to 300 before. If it's more, the numbers are more than that, it's probably not a fit.
Very good, excellent, very helpful.
And if you wanted to talk about pivots a little more, because we've got data across, almost 1,000 different companies that we've seen evolve over time. And what we've noticed is the most important thing at these early stages, and one of the things we care the most about, is cash burn. And what ends up happening is if we invest in a company that has, let's say it has 10,000 a month, 10K MRR right now, and they go out of the gate burning 40, 50,000 a month in revenue, they've probably raised a round where they've got 10 months of runway. Just a few months in, the company's starting to stress about this cash wall they're going to hit, later that year. And subconsciously, those founders and that team is going to have blinders on. And they're going to be of the mindset of, we've got to make this business model that we're on right now work, or our company, we go out of business soon. Mm-hmm. If you take that exact same profile of company, and instead of 40 or 50,000 a month revenue, they're, of cash burn, they're burning, 10,000, 15, 20,000 a month. Mm-hmm. That entrepreneurial team is not going to have those blinders on. This is all subconscious. They're naturally going to be sort of have their heads up looking, is there any opportunity that's greater than what we're currently doing out there? And that company, even if they get from 10 to 20K MRR, if in talking with their customers, they discover a need that's much greater than the one they're addressing, they might feel comfortable throwing out their entire business model and pivoting to that new product. And they're going to be okay doing that, because when you're burning that small amount, you still might be running out of capital in 6 or 8 months, but it's not as stressful if all right, at worst I can raise 150 or 200 and I've got another year, or 10 months or a year. And so that's what we look for the most. And I could walk you through an example of one just this year that we invested in that sort of had unusual and had that phenomenon. So we invested in a company, I think it was just May of last year. They had somewhere between 5 to 10K MRR. I think it was around 8. It was a B2B SaaS product for the SMB market. By the end of this year, they were up to around 30K MRR, which is pretty impressive. And they had raised, I think less than 100,000 to date before we invested in them. But interestingly, along the way, they had multiple of their customers ask for a specific product that was substantially different than the product they made. And in November, they made the decision, we've had enough people ask for this and we could build it. Let's try building a prototype of this and take it to market in January and see what happens. And they built this new product, and they went and they did a pitch to like 50 different customers, and it was incredible, like 80 to 90% of them signed up for this and said we would buy this. And it's sort of close ratio you just never get. And so here's a company that had just gone from, 8 to 30K MRR, and they came to this decision, that we're going to toss our old product out the window, and basically we'll make that sort of a light version of that that's a free plugin, and this new product's where we're going. And they've gone out and they've just signed up about 70K worth of MRR in 2 months for this new product. And the only reason they were able to do that is because they had low cash burn. If they were burning a lot, their answer to those companies would have just been, no, we can't build that. That's not what we do.
Yeah. Cool. So how many deals do you see a year?
A large number. So we get asked this question a lot. How many deals do we have to look at to see what we do? And we have a lot of sources of deal flow. So it really depends on the channel. So one of our major ones is actually just random people that come to us off via email, inbound, LinkedIn, internet. We drive everybody to a page on our website. So if you go to rightsidecapital.com/submit, we spend a lot of paragraphs explaining what it is we look for in companies. And at the bottom, if you think you're a fit, you can fill out that pre-screening form, and we respond to 100% of people that fill that out. Through that channel, though, it's a very small percentage that we end up, even going to the next step. Most of the time we're saying you're not a fit and here's why. And I'd say the percentage that we end up investing in is a low single-digit percentage. On the other hand, we've got over 2,000 existing founders that are out there and are scouts on the ground and have a really good idea of what we're looking for and referring deals in. Those deals, because they're a bit curated and they have a pretty good idea of our investment philosophy and what we're looking for, it's a higher percentage that we're going to end up investing in. That might end up being in the 10 to 20% number. And then we work with a lot of startup accelerators. There's a handful that we provide the capital that they use to run, and we get a piece of sort of every company going through the startup. And then there's a number that we work with where, we're one of the few investors that can move quickly and will invest in companies on the way in or during the first month of a program. So, the question is, if a startup managing director gets 800 applications, screens it down to 10 that they let in, and then gives us a referral to 3 that they think would be a good fit because they know our profile, and we say yes to 2 of those, did we just invest in 2 out of 3, or did we just invest in 2 out of 800? I'm not sure what the answer to that is. And there's other channels beyond those, so it just varies a lot.
Cool. All right. So I guess the question I was trying to ask you, you gave a very good and interesting answer to a different question, but the question I was trying to ask you is, across your different, the deals that you see, let's say if you look at the last 12 months or 18 months, what trends have you seen?
Yeah, so the biggest trend is sort of an extension of a trend that we've seen the entire time we've been investing, and that's an extension of sort of a 30-year trend in the software business, which is that at the earliest stages of product formation, when you're actually building your product, it's just gotten cheaper and cheaper every year to build that initial product or prototype, to get it to a stage where you can sort of go to the market and prove if you can generate revenue or not. And, that was probably $25 million in 1984. It was, $5 million in 2004. It was, $1 million in 2010. And, when we started investing in 2012, the average company probably had to spend $250,000 to $500,000 just to get a product to the point where it could take it to the market and see if it could sell it at all. And I would say by 2015, in the software world, that average cost was down, below $200,000. And today's world, it's even lower than that. So the biggest trend that we see is because of that, there's a lot more startup activity, particularly in the software spaces, and the cream of the crop each year just has more and more revenue without having raised that much capital. And they're able to sell to customer profiles that you wouldn't have thought possible to sell to without that much capital. So a year and a half ago, we thought, hey, this is really interesting. We're now seeing a lot of companies each year that haven't raised anything and actually have a product that's generating $10,000, $20,000 a month revenue. But we weren't seeing companies that had enterprise products, where it was $1,000, $2,000, $5,000 a month price points that had raised hardly any revenue. And in the last 12 to 18 months, we're starting to get a steady trickle of those. So companies that have raised anywhere from nothing to, less than $150,000, and they have products that are like $2,000, $5,000 a month products, and they actually have customers paying them and using it. It would have just been unheard of 2 or 3 years ago. The conventional wisdom is you needed $1 million to do it.
I have a slightly different analysis of this trend. I think it's not that it's become cheaper to build these products. It has become cheaper. Of course, it doesn't cost $25 million anymore to build anything. But I think it's because entrepreneurs have become a bit savvier about bootstrapping, and I will take some credit for pushing this message heavily. I think people realize that it's a much better deal to bootstrap first, get to level of validation, including paying customers, before going out and beating on VC's doors. I think people are starting to understand that entrepreneurship doesn't equal financing. You don't wake up in the morning and go start beating on VC's doors and expect anything to happen. So I think people are realizing that they have to put in 12 to 18 months, sometimes 24 to 36 months of bootstrapping before they should go out to raise financing, and they're just not wasting time going to VCs doing that.
Yeah, I think that contributes too. I mean, at the end of the day, there's just a lot of factors. So, I mean, there's that aspect, but, also developer tools are just more powerful than they were 3 years ago, 6 years ago, 12 years ago. So 2 developers today can do what it took 6 to do 5 years ago, and the same 5 years before then, and you just have so many more cloud products, tools, and services that you can leverage as a startup that you maybe had to build or pay for, at much higher prices for earlier on. So there's no single answer, but I definitely agree what you said contributes a lot too. It's just a lot of factors have gone into this. But at the end of the day, there's a lot more companies that have been able to get, generate capital with relatively little raised, and these days even generate capital off of some enterprise products with relatively little raised.
Yes, great. Well, that was a fascinating conversation, exactly what we need to have our audience hear. So Dave, I hear that you're going to stay a little bit for the entrepreneur pitch session.
Yes, I will be able to. I don't know if I'll make all of it, but I'll definitely be able to make the first half.
Okay. So folks, we're going to switch. I just want to set a little bit of expectations here. This is a working session. You can bring anything you want to discuss, whatever it is that you're stuck with or whatever it is that you're, confused about or need some clarity, discuss something. We'll work on that. It is a safe place. You don't need to be nervous. You don't need to be defensive, but you do need to be able to hear and process candid, authentic feedback. We're not going to sugarcoat our feedback. We're going to tell you what we see, what we think you ought to be paying attention to. And it's okay if you disagree with the feedback you get here. It's your venture. You're going to do whatever you want to do with it. But know that people who are giving you this feedback have seen a lot and are giving you feedback based on, most of all, based on patterns that we have seen in the ecosystem of what works, what doesn't work. We're going to start with Praveen from Hyderabad. Praveen, please unmute your line and tell us what you're working on. Praveen, are you on the call? I see him on the panelists list, and he seems to be on the call. What's happening?
Video just went on. It might be muted.
Go ahead. We can see you on the video. Is your line muted? Praveen, speak. Maureen, what's going on with Praveen's situation? Does he not know how to? Praveen, are you speaking? We can't hear you. Okay, I'm going to move on. We can't waste time waiting for people. Ajay Nagar, are you on the call?
Yes, ma'am. I'm here.
Go ahead. Go ahead with your presentation.
Yep. Thank you. Hi, everybody. My name is Ajay. I'm based out of Frisco, Texas, and I'm going to present my company called Mobstar today to all of you. A little bit about me. I grew up in building management and data centers, been working with Schneider Electric, or I worked for a company called Schneider Electric from 2012 until 17, and then broke off to do consulting on my own in a very specific field called data center infrastructure management. And as we go through changes in normal operations activities in any mission-critical facilities, operational procedures and maintenance checklists are critical. Any change essentially that happens that can impact and any change to critical equipment that can affect IT load in a data center or airport operations, for example, has to go through proper change control and documentation process. And part of that documentation and change control is what we call MOPs, method of procedures, and SOPs, standard operating procedures, and EOPs, emergency operating procedures. And the way the industry operates right now is MOPs and SOPs are created in Word document or spreadsheets and get exchanged, forwarded, downloaded via email, and all the actions and triggers are manual. So if I need approval to a MOP, I'll have to send an email to 4 people, and one of them will have to forward it to someone else who is a subject matter expert. And everybody would just reply all saying approved. And you can come in on March 17th to do the install. A lot of times I've seen time wasted and people just showing up on site, technicians, with no preparedness because no proper planning was done. So the generic tools that we use, email, spreadsheet, SharePoint, some wiki pages, they make the whole process very cumbersome and it's very error prone. It's very difficult to find information out of these manual documentations. So what I'm trying to do is help mission critical facilities such as data centers, hospitals, airports better manage their operational procedures and maintenance checklists, not just the document piece of it, but the entire workflow. Mobstar is a comprehensive solution that's one-stop shop. The users that use Mobstar, they don't need to use any other tool as opposed to previously they're using 5 or 6 different applications to manage the entire process. Next slide, please. Data centers is my primary target right now because this is the industry I grew up in. This is where I have most of my network. Just to give you a brief idea about driving forces, cloud computing, 5G, social media, smart cities, autonomous cars, all of these things need data and processing at some level or the other. And there's various studies that says more than half or 90% of the data that exists today got generated within the last 2 years. So we're growing at a crazy rate. The CAGR anticipated for from 2018 to 2025, it's at 10.2% right now, and the data center construction market in 2017 was $43.7 billion. I believe 2018 was 47 something. I don't have the exact figures on top of my head. So that's my primary target industry. Where's the company today? The idea and concept came to my mind in December 2017. We had a working prototype May 2017. I started working with my close network. Since I've already been working in data center industry, I had a couple of really good friends who manage facilities. I kept showing the software to them monthly basis and kept getting feedback. So finally, my first purchase order came in last month, and I have 2 more coming in this month. Right now, I have traction. I have product market validation. I'm I'm going to a conference next week to present this and meeting with 6 different customers of various sizes. And the next plan is to grow and sustain and get to cash flow positive. How do we make money? What's our business model? It's a yearly licensing fee based on mop count. And so if it's a small enterprise bank, for example, they'll do 500 to 1,000 mops, and I can charge them $3,000 per year, as opposed to a service provider such as CBRE or JLL, who does thousands. The pricing model scales. How we sold or go to market in 2018, it was direct sales because it was my first degree network people I worked with. In 2019, I've started recruiting channel partners and resellers because I realized I cannot do everything on my own. And I have a lot of support on software development side. I have 4 part-time developers supporting me, but none on sales. And I tried doing this, and it's
Ajay, what is the price point you said?
The price point for for Mobstar, it starts at $3,600 per year for 500 node license, and it goes all the way enterprise to $15,000 to $20,000 depending on the size.
So, I mean, if you're talking about large data centers, what would be an average deal size?
It depends on. So for enterprise, it would probably be $10,000 to $12,000 just in licenses, because enterprise, again, they have different requirements for MLPs. Just to give you an example, a UPS battery replacement can need a mop or cannot need a mop. There's no standardization across our industry. So my anticipation is an average deal size would be somewhere between $7,000 to $9,000 in licenses, and then we have professional services that we do to identify where the process is broken, identify what all mops do you need and SOPs do you need, and then go work with the manufacturers, the Eatons, the Liebert, the APCs of the industry, and get operational manuals from them and prepare MOPs. And in 2019, late 2019, I'm also going to plan to launch a managed version of Mobstar, which is we take care of everything end-to-end. All you do is log in. Right now, it's an on-prem install, so the customer still owns and manages the install. We just configure it. But late 2019, once I have the architecture a little sound, the plan is to have a 100% cloud-hosted instance.
And this channel partners you're talking about, have you identified channel partners who have access to lots of data center customers who can support you?
Yes, ma'am. Yeah. Yeah. So by channel partners, I mean real sales partners. And these are not exclusive to me. I've worked in DCIM, data center industry, and there's a lot of people selling UPSs, generators, switchgears, PDUs, RPPs, and software to end customers. And I met with a lot of these guys at networking events, and if there's no conflict of interest, they're actually happy to help me in making connections and taking a cut off of it. So I found this model. I have two sales partners, by the way, right now. So I've identified them, working with them. We proposed one of the POs that I'm waiting on is coming through this channel.
Do you have any metrics that you've put together that show, if one of these data centers is paying you $1,000 a month, what's the economic benefit that they're getting from that? Like, how much are they saving in either labor or parts that they don't have to purchase or something like that?
Yes, sir. So on average, facilities one team member spent 47 minutes just finding information and data they need to make decisions. So that's my most basic ROI. 47 minutes
a month, 47 minutes a year? What are you talking about? A day?
47 minutes per day.
Okay.
Yep.
But that's just on
research.
Each team member is doing that, and you're saving how many for your profile of a customer that's paying you $1,000 a month, how many people are you saving an hour a day for?
So let's say if a data center like TierPoint, they have a team of 4 people, then let's say 30 minutes per day is what I can save them, 2 hours per day of man time. Multiply that by 100. So that's the basic ROI. And on top of just the amount of time saved, the efficiencies gained, And the way mobs can avoid human errors, which is a lot, you would see in February, Wells Fargo had a smoke condition and their ATMs and online banking just went blank. That happened because of a smoke condition, part of maintenance routine activity that shouldn't have happened. Same thing with airlines. American was grounded, Delta was grounded because of all of these human errors.
So at the high level, I think you're going after a market that you know well, and there's a problem there. I'm curious as to whether or not your unit economics work out. Like, are you charging enough for this product, or will they pay enough? Because it sounds like this is a sales cycle. It's not going to be. This is not going to be a profile of customer necessarily where you get introduced and they make a decision in 4 or 6 weeks. This sounds more like a 6-month sales cycle with some pretty hefty implementation time, and I'm not sure if at the end of that your top line, your best case scenario for your high-end customers is getting $1,000, $1,200 a month, if that's going to work out over the long run.
Yes, sir.
So what Dave is telling you, Ajay, is that can you profitably sell this product at these price points and at these average deal sizes? And that's something that you're going to need to look at very closely across all the factors, including what does it cost to use these channel partners? If you're talking about real resellers who are going to do real professional services, you have to work through the unit economics of those deals and see if is there enough in here to be able to support those kinds of conversations.
Yep. I agree 100%.
Yeah, and you should experiment. I mean, one of the ways you find out is by experimenting. You need to, for your next couple customers you talk with, try going in with much higher price points and see if they, and if they say no and it immediately kills it, that's okay. You're learning right now. That's information you're getting. But they might say yes, and you might sell at that price point for your next 5 customers, and then you try raising it again. And one of the things that entrepreneurs often don't understand for enterprise products is they go in and sell a product and they see, how can these existing players sell it so expensively? Why are people buying that? My cost isn't that much. But at the end of the day, your cost doesn't have to just cover the sales cycle for your customers that say yes. For every customer you spend 6 months with and they say yes, there might be 3 or 4 others that you spent 6 months and they say no. So that one successful one that's paying you has to not just be profitable for the time you put into it, it's got to cover all the other customers you talk with that you got to know from, and then you have to have a hefty profit margin. So just things to think about. So,
yep.
Going forward.
Yes, sir.
But the good thing is you are going about it in the right way. It's a domain that you understand well, and
yeah.
You have already paying customers. That's a very good start. The rest you can figure out from there.
Yeah, and it sounds to me like you're solving a problem that's actually much bigger than just the time savings. You're giving them peace of mind that things are less likely to happen that cost them hundreds of thousands or millions of dollars, and therefore your product probably is worth a lot more than you're thinking.
Yeah.
Yes, sir.
All right. Very good.
Yep. Thank you.
We have to move to the next presenter, Ajay. We can come back to you during the Q&A session if you like.
Thank you very much.
You're welcome. Okay, Gina, you were up next. Gina Milani.
Can you hear me okay?
Yes, we can hear you. Go ahead. Yes, go ahead.
Well, thank you. I just want to thank you to start off for the opportunity. It's very exciting for me to be here, and thank you for all the resources that you've provided that's gotten me here. My project is very much a niche play, but I believe it has a much broader opportunity to scale. So let's dive in and go to the next slide. I guess I should back up you can read the slide. My background is in enterprise software, but I am a PR professional. So all of your presentations, Dave, was very interesting to me as well. In public relations, storytelling takes on many forms and often requiring a variety of tools to do your job well, now more than ever, actually. And if you're trying to make a buy decision on PR infrastructure tools, it's important to feel like you've really done your homework because you're going to spread that cost around your clients. First, you have to find them. Then you have to see what you can afford at your stage of business, and only then can you start your in-depth evaluation. So having firsthand experience with this, I added up all the hours that each individual might be spending doing the same research, and the result is just an obscene amount of valuable time wasted. Before we go further, about market validation, I just want to say that some years back, my original idea was much bigger. It was called PR Service Bureau. And at that time, I conducted some market research and a survey through my PR professional colleagues to assess what might help them the most. And I added a question: if there were a database of PR tools to help you easily find tools, would this be something beneficial to you? So 100% of respondents said yes. And that's what I decided to focus on over time. So next slide, please. I've been working on PRToolFinder largely on my own, self-funding along the way, and it went live in 2016. Put some effort into SEO and a little bit of marketing, but not a lot. So at this stage, what I'm seeking is, maybe it's not a funding partner, maybe it's more mentor, but I believe I've taken this sort of as far as I can take it on my own with the personal investments that I've made. So I'm looking for either with the funding partner or mentor that can extend guidance into pricing and digital advertising best practices. At this point, I know what I don't know. So next slide, please. These are just a few of the main categories in PRToolFinder. It might surprise you to learn that there's like 20 categories. I mean, in terms of you're trying to make these easy to find and understanding how you use them. Next slide, please. And even if all you're looking is to buy a media contact database, one of the most basic tools in PR, there's still 12 options. Prices and functionality vary widely, and all of these options won't just roll up in a simple Google search of media databases. And I actually hired someone some years back to do some evaluate media databases because I didn't have time at the time with my client load, and it took 15 hours. That's a lot of time. Next slide.
So Gina, currently are you monetizing any of this, or you're not?
No. I will get to that. That is the next step. That is the next step.
Okay.
The target market, as you can see, are PR professionals, agencies, and in-house. I actually, as a solo practitioner, I'm very active in the Public Relations Society of America's Independent Practitioners Alliance, having been a past chair. But, you don't have to be a PR pro to want to find some of these tools. People who blog, they want to create podcasts. Businesses want to know how to measure their social media sentiment. Just a lot of.
Yeah, but now you're going off in different tangents. Your positioning to begin with was very crisp, and now you're going off in various tangents. If you're creating a tool that specifically caters to PR professionals to do their job, that's a positioning, and I think it's a reasonably crisp positioning. If you go off in tangents on helping bloggers measure their effectiveness, that's going off in directions that are not going to be so easy to monetize. So, I would say
how I'd like you to look
hold
at
on, let me speak. If you keep speaking over me, I will not be able to communicate what I'm trying to say to you. Okay. So there are blueprints of these kinds of businesses. Yelp-like businesses have been built. Is that the right strategy? Is the Yelp-like business the right strategy for you? Yelp has certain monetization paths. You can look into those and try to replicate those. But there are other, paths that you could also consider, which are more subscription kind of models. I haven't decided. I haven't looked at it well and closely enough to decide what is the right monetization model for you. But let's listen to Dave. What do you think, Dave?
Yeah, I mean, it's hard to know without knowing sort of more information about, if you've been doing this for a few years, what's the usage that you're getting right now, and what's the profile of person that tends to be coming to your site and using it? And then, are you reaching out? What I would recommend, it's sort of going back to the lean startup approach. You need to find the users that are using you right now, learn what their profiles are, and call out to dozens of those, or put them into different bands of profiles and ask them how they're using your product, ask them what the biggest pain points are and what the jobs that they're doing, and ask them what are the things they'd be willing to pay, problems they'd be willing to pay to help solve, and does it look like what you're doing it could solve some of that, or a mild twist or change to what you're doing is something extra feature functionality that would help them a lot. And at the end of the day, you know, you need to find a business model out of it. It's very, very hard to go down the path where you just get a lot of users using you for free and you sort of monetize them on the back end. There's successful examples of that, but for every one of those, there's 1,000 companies that tried that and it didn't work out so well.
And it's very expensive to build those companies. These advertising-based business models are very expensive to build, and I mean, by and large, I try to discourage people from following that path. So, Gina, on your question about mentoring, obviously you've come to a place where that's what we do for, you know, as our reason for existence. So if you just hold on for a bit, let me go through the other two pitches, and then I will explain how to use the program for mentoring and for support, and you can just...
I was hoping to finish my slide deck, but if that's not something that you will want me to do, then I don't have to. But
well, go ahead.
Run through them very quickly.
If there is more information here, go ahead.
Yeah, there is actually quite a bit, and I would like to, I'll run through it very quickly.
Go ahead.
The point of this slide is that there is an educational component for my target advertisers, and that is that in higher ed, it's not unreasonable to expect that they would use the database in their coursework and communications, giving tool vendors early exposure into tomorrow's customers. This is how I knew that, which I think is you know, high praise coming from enterprise software. This slide is the market size, and it does show, you know, PR is a modest size. I'm hoping, I was going to say earlier, that I'd like you to look at this as a case study of how this can scale to just the general small business population, which in 2008, there were 30.2 million small businesses in the U.S. Okay, next slide. From a competitive standpoint, there are 4 competitors I've identified listed here, 3 of which have been acquired by Gartner. I have a few quick stats about them. These 3 Gartner properties see 4 million unique visitors a month. They offer geo-targeting by country. They have an in-house team to help customers acquire qualified reviews for free. And they use a PPC model, which is very interesting, that I also hope to leverage in the future. It's paired with a dedicated marketing advisor to help them leverage and grow their campaigns. So Gina,
I have a comment about this slide.
I'm sorry?
It terrifies me to see user cost free on all these competitors, which means it's going to be very difficult to charge for this product. And the freemium, you know, free users, and then there's a premium for pro users or premium users. Premium has terrible conversion rates. So building businesses with a premium model and competing with so much free stuff out there is terrifying.
Well,
so that's just a comment. Just take it away. You don't need to react to it right now, but it is a comment. It's a concern.
Well, and I appreciate that. I mean, in my view, PRToolFinder is not only more complete, offering listings of both paid and free tools, which users would appreciate, but it has a higher degree of tool segmentation. I was not able to find a valuation on the Gartner properties, but G2 Crowd was founded in 2012 and is presently valued at $300 million. I think they raised an additional $55 million 8 months ago. Advertising opportunities, these are just a few. I think additional products that could be developed in the future are sponsored case studies, custom research, possibly even micro-newsletters that focus on high-change categories, much like the Washington Post has been doing, I think. These numbers are...
So these are, I don't think we should go over revenue numbers, revenue potential numbers, because there's, you know, this is, I think you have to first figure out what is the right business model for it. And this is kind of cart before the horse. I don't think it's...
Okay, well then let's just quickly run through. These are just some of the potential tool advertisers in PR. Next slide, please. I think with enough site traffic, the next slide, we can attract horizontal business and higher ed. Next slide. That just shows we do have traffic, not a lot. That's because we haven't been doing a lot of marketing. That is the next step. I wanted just to get some feedback first, and which has been good, and I appreciate it. Next slide, please. These are some likely industry partners. Like
So
I said before.
This is not a fundable situation at the moment at all.
Okay.
What you have at the moment is not a fundable business. So we have to figure out how to put in place something that you can build, block by block, put one step before the other, without assuming that you can raise financing at the moment.
Very good. Then that's the feedback I was looking for.
Yeah. All right. So, Gina, we can do more Q&A in a bit. Let me finish the other two presentations, and we'll come back to you.
Thanks again.
You're very welcome. William Chow, you're up next.
Hello? Can you hear me?
Yes. Yep.
Okay,
Go
great.
ahead.
Yeah, first off, I apologize for the quality of the slides. Just kind of, they're kind of old, so we put them together. But anyway, what Alitrope is about is we are in the, we're trying to make reward loyalty points more attractive for people and to have a more engaging way for people to actually earn loyalty points. So if you can put the next slide over. Next slide. So our mission statement is loyalty points. We want to make it a lifestyle instead of just like something you kind of like just kind of throw in the back. Like if you ever go to McDonald's, they always have like a survey where you get like a $1 off your next meal, and probably 99.9% of people never take that survey. And so we're trying to see if we can engage people more. So if you go to the next slide. So in summary, I think everyone knows this problem. It's very straightforward. Loyalty points are not transferable. It's difficult to incentivize patrons from using loyalty points. Customers definitely do not value loyalty points in general. I think that's pretty much the case. I think there's like a 2% penetration for like people actually using your loyalty points, maybe lower. It's difficult to develop logistic and financial processes and ROI for your loyalty points. And also loyalty point programs. There's a lot of burnout. So there might be like a bit of high initial usage of these points, but they burn out really quickly. Okay, next slide, please. So what we're trying to do is we're trying to offer loyalty software as a service, and how we want to engage people into having more loyalty points is to offer short, very quick surveys, and through surveys we incentivize people to take these very quick surveys through loyalty points. We have an iPhone and an Android app for that. We have a data. We want to gather data and analytics through these surveys and through the usage of loyalty points. We want to be industry compliant, and we want to have a way to exchange points. Next slide, please. So this is the architecture we came up with. We partnered up with Verifone and with Point. So our application works seamlessly with point of sales. And what we do is it's a very simple architecture. What we do is we have users download the app. It's an iPhone app. It integrates with the point of sale through both NFC and the QR code. We store the loyalty points on a blockchain so that they're easily transferable between merchants. That's the fundamental. And so we vend out surveys, vendor-specific surveys to people who are going to a specific vendor. So if you go to McDonald's, you get like a McDonald's survey. How do you like your burger? Or if you go to you go to like Costco, if you went to change your tires, how are the tires, etc. And the idea here is that people will take the survey if they are actually awarded for these. And in addition, the points themselves will hopefully be perceived to be more valuable if they are able to be easily exchanged. And so we facilitate that through a blockchain exchange, so that you can so if you go to Starbucks once a week and you get like a whole bunch of points for that, you can exchange it for different kinds of points.
So the main point you're making is that you're going to create a transferable loyalty point exchange which is loyalty points earned in exchange for taking surveys.
Yes, exactly, right. hopefully that came through. So again,
so can I suggest one thing? It took you quite a while to make that point, right? That is your positioning. That positioning should be very early on in the presentation. That should be your opening slide. You're making transferable loyalty points. The blockchain is an enabling technology. Blockchain, I know it's a buzzword. You want to throw the buzzword out there, but the reality is your value proposition has nothing to do with blockchain.
Yeah, I'm a little confused why you need a blockchain implementation. Couldn't you do this just as well with a database?
Yeah, exactly.
No, the reason why we're using the blockchain is because we are distributing these points on an exchange, and we want to have the point potential. We have the blockchain EC20 compliant or whatever, so that you can hopefully transfer these points to other types of currency, like cryptocurrencies, right? So that we can actually even put the points, and if they ever become like valuable enough, right? I'm not saying they will be, but if they ever become valuable enough, you can like partner with someone like the major or minor exchanges. So that was
who's paying for these surveys? So if I'm a small business using this, every time someone takes a survey, I've got to pay you for them to have taken the survey because you're giving them points that are worth something.
So the price, how we're going to make money is up for debate. Again, this is very early on. We essentially have built out the technology. We've shown it to Verifone and to Point, and we're trying to find our first beta kind of customers. This is all self-funded, so we're not looking for any like major seed capital or anything like that. We just want to, try to get this, see if this will actually be a product in itself, and how we're going to monetize it is still up in the air. So, we could go through the SurveyMonkey route. I don't know if that'll work with small businesses, SMEs, right? I know they're very price sensitive, so therefore, what is the right pricing model for that, right?
If you're going to be giving people,
SurveyMonkey is a very different product.
Yeah, and if you're paying people to take a survey, you're giving them something of value, and someone's got to pay for that value you're giving them, and then you've got to make profit margin on top of that.
Top of that.
If the model is that value you're giving them is going to be tokens that are going to magically appreciate because everyone thinks they're worth something, that's not a business model. That's likely.
No, I don't think that's a business model at all. You need to see, the thing that bothers me, William, about this situation is that you don't have a hypothesis of how you're going to monetize. You're going down, building a certain product and bouncing around a certain segment and with a value proposition with no business model hypothesis. That needs to change. You may change that hypothesis, you may morph that hypothesis as you learn more, but you have to have some viable hypothesis before going down this path, and you need to talk to enough people before you build a bunch of stuff.
Yeah, and at the end of the day, your primary customer is not the people taking the surveys, it's the small businesses that you're selling this product to, and it's not clear enough what the value prop is to them. You've got to, what you're trying to deliver them is more surveys and information. So do you have evidence that some profile of customers willing to pay a fair amount of money to get that more surveys and information about their customers? And how are they going to be confident that you're going to be able to deliver that to them? Because it doesn't seem like there's a simple small-scale test of this where you're going to show that you got a lot of people to take surveys.
Right. So that is where we are. So that is what I'm trying to establish here. Is in fact a test bed customer or customers, like one or two, to get more product feedback to see whether this is viable or not, right? So this is definitely like very early stage, as I mentioned before. So this is like we don't have like a recurring revenue stream or anything of that nature, right?
Yeah, I mean to start with, you should go and call out to 40 businesses that you think would be their target businesses that you might do this, and ask them, is this a problem for them? Would they be willing to pay for something that got them all the survey information, and how much would they be willing to pay? And unless you get some really compelling answers there, if you don't think it can be sold pretty easily to that customer, the rest of it doesn't matter, right? You've got this
absolutely.
basic assumption that has to be proven before anything else matters in it.
All right,
absolutely.
folks, we're going to stop. We're going to end there with William's presentation because we still need to give Praveen a chance to pitch. William, thank you. I think we gave you some background. I just want to say one thing. Please don't build a lot of software without getting some understanding of what business you're going into, because the software is going to be, absolutely useless unless you have a sense of what you're building and why. Okay, Praveen, are you able to call in?
Good morning, Suvarna. Am I audible?
Yes, we can hear you. It's a little bit garbled. You have to adjust your speaker and so forth, and then go ahead and do your presentation.
Sorry, I'm really sorry, guys. Actually, I have a poor connection on my side. Am I audible?
We can hear you fine now. Go ahead.
Oh, sure. Okay, thank you so much. Good morning, guys. I am Praveen Ansuria from Hyderabad, India. So I started a company called MetaFact a few years back, which we work on basically on this online disinformation. In Jan 2019, I started a company called DigiBeings along with a few of my friends in IIIT Hyderabad and chatbot developers, where we aim to develop photorealistic digital humans with emotional intelligence, which can do face-to-face conversations. Next slide, please. As you already know, chatbots and voice interfaces are just 3 to 4 years old, but we already see their extensive applications in digital interfaces, and currently they are replacing apps and websites in terms of interactions. But the fundamental problem is they're completely verbal, where the human communication is mostly non-verbal. Most of the companies are working on emotional intelligence, especially on text analysis and voice analysis. But again, the fundamental problem is most of the humans, what they speak or write, usually that doesn't mean what they speak or write. So it's very important to do facial analysis to detect accurately the emotions. And that's what we do at Digital Humans, because it can do face-to-face conversations. Using asking the permissions of the user to, on the camera, and it can do both verbal and non-verbal communications using gestures and hand movements, and they're very high on emotional intelligence. Next slide, please. As of now, we are targeting large enterprises and growth stage startups, especially in customer support. Who are looking to include new kind of experiences for customers in customer support. And we are targeting banking, healthcare, retail, education, prop tech, telecom, hospitality, and entertainment sectors. Next slide, please. As of now, we did a customer discovery with banks, who are reaching out to startups for a co-innovation project. So we especially pitched it to HDFC Bank, ING London, and N26 in Germany. So what we found is these banks are looking at new kind of experiences which can humanize digital banking experiences and hold deeper conversations than chatbots or voice interfaces. And they also believe that recognizing the client frustration early on is a very important step. And they also believe emotion recognized can increase customer loyalty. They also want a technology which is friendly to disabled and technology challenged people. So we pitched it especially to HDFC Bank in India, and they are currently, they want to have a look at MVP and then make it a paid project. Next slide, please. So we have a B2B revenue model where we charge a fixed cost of 200K to 700K just to develop the conversations. And so unlike our competitors, we are not charging upfront fee for digital humans, the 3D models. So they can hire those 3D models annually. And we also have a variable cost, especially the number of API calls that the customers make. And on premium side, we also aim to work with companies who want to develop a proprietary face to represent their brand. Going forward, we will be developing a platform for developers, especially VR and AR developers, where they can use our readily available 3D assets and digital humans in their environments. We also, in the platform, the celebrity management will be also included. We are, have pitched it to currently few management agencies where we want to manage the digital copies of the celebrities. Next slide, please.
Interesting.
So the question which I have is currently, though we are huge fans of bootstrapping, and I have built my earlier company completely bootstrapping, but this company, it usually takes a lot of technical and artistic talent. At least there are more than 10 departments included in it. So usually, if we bootstrap, usually it will take more time to build MVP. Though we already started building MVP, but if we just depend on bootstrapping, it will take more time. And at the end of it, we might not be having a proprietary assets which can make the MVP non-commercial. And we won't be having a full-time team when a client approves a project after seeing the MVP. And we also might end up diluting a lot of equity to onboard more co-founders. So this is where I want to take your advice to build this kind of startup, whether we should bootstrap or to pre-seed, which can help us to, execute things faster. And also, one thing to be noted is like
I understand your question.
Okay.
I understand your question.
In the
interest of time, let me start answering it because I think that is your crucial question. The real question here is whether it's not whether you want to raise money or not. The real question is, can you raise money or not? And in this case, it's not clear to me that you can raise money, because if I put my pre-seed investor hat on and think that, hey, am I going to invest in this company at this stage? The question that I'm asking is...
I can hear you in bits and pieces. Hello.
Sorry?
No, I was able to hear you on bits and pieces, actually. So, yeah, sorry. I think the connection is weak.
I'm going to answer you. You can pick up in the recording because we're getting to the I'm not going to repeat the whole thing because there are other people listening. You can pick up the answers in the recording. But here's the way to think about this. If I put my pre-seed investor hat on, I'm thinking, what is the guarantee that Praveen Anasuria can build this product? Because it's a very complex product. The level of complexity of this product means that I have to have a founder whom I believe in his or her technical ability, or a founding team that can deliver on a product like this. Otherwise, my pre-seed investment can basically be a complete, bomb. So it's not clear to me that you will necessarily be able to raise money for this without being able to show something and be able to deliver on something that has some validation. Dave, what do you think?
Yeah, I think it sounds like novel technology, and I agree. There's a lot that goes into building something like this. But then you have the next step is that just because you build it, will companies pay for this, right? I can envision, if you ask me at some time in the next 20 years, will there be large brands and companies that have a custom digital face and persona that interacts with customers? I could see that happening. But, someone who's investing in you now is banking that that's going to happen in the pretty near term. And so you're going to have to, I think you need to give some pretty solid evidence in terms of like a paying customer or someone who's, you have a product right now that you're saying companies are going to effectively pay you many hundreds of thousands to millions for. If they're going to pay that, you need some validation that maybe you should be able to find some company that's committing that says, hey, I'd like to see this. We'd like this on our roadmap in the next couple of year or so. Maybe they would do a paid pilot that's not as expensive as the full product, but is expensive enough that you guys can fund some of that development. Unless you're showing me that there's, let me take as faith that you can build this. You still need to show that there's some evidence there's revenue at the other side of that bridge.
So Praveen, the answer to your question is you should do bootstrapping using services. So you should structure some of your pilots as services projects where people have to pay to, you keep intellectual property, but people have to pay you to kind of do it almost as a contract software development, something like that. Otherwise, you will neither be able to build what you need to build nor be able to raise money. So we have a very definitive track in 1Mby1M where we support the bootstrapping with services mechanism. We have lots of methodology around it. You can follow that methodology and go down that path. But I think trying to raise money at this stage is going to be almost impossible. I may be wrong, but I think it's almost impossible to raise money with this right now.
I would agree. You'd have a much higher percentage of success trying to get a company to give you $500,000 to build something for them over the next year that they can then.
If they're really interested, yeah.
Yeah.
That's right. And that will also give you validation that there is need and interest and market demand. That's a very good signal from the market that market wants your product and want to include this functionality in their offering. Okay. All right. So that concludes our scheduled presentations. I'm going to give you just 3 minutes of explanation on how to use the program for those of you who are looking to use the program, and then we're going to go back to Q&A. First thing is I have an ask from you. If you like what we're doing here, as you can see, this is very direct feedback. And not everybody has a stomach for receiving this kind of direct feedback, but I hope we're able to communicate to you that we are on your side. We want you to succeed. And we want people who are serious entrepreneurs to work with, who will have the stamina to do what it takes to bring a product to market. And if you have people like that in your orbit, please refer them to 1Million. We'd be delighted to work with them. So resources-wise, everything is at 1Mby1M.com. You will find a terrific blog, which a lot of people just access for free and learn a lot from. There are many hundreds of thousands of people over the last 12 years who have been reading, more than 12 actually, 14 years that have been reading this blog and have learning through it. So you can also do that, and that costs you nothing except your time. The Entrepreneur Journeys book series could be a good starting point for you to learn bootstrapping using services. We just discussed, we have a book on this topic, and these are case study-based books. Each book has 12 to 16 case studies, so you get to learn from people who have done it before, and that's invaluable. We have 12 volumes, all available on Amazon, very reasonably priced. These roundtables happen every week, and over 100,000 people have attended. You are welcome to reserve your slot to pitch and come discuss your strategy with us. The full acceleration program is 1M1M Premium, and that's where we offer you extensive methodology guidance. We have an online curriculum that is video lectures and case study based, and lots of video interviews as well, just like what we did today with Dave. We help you with business development. We have a terrific Rolodex, which is available to all our premium members, whether it's introductions to customers, channel partners, investors, media analysts, other advisors. We have the Rolodex open to you, and we give you the same format of strategy consulting, but for our premium members, we have closed door sessions the recordings are not published externally. And they happen on a regular basis, weekly, sometimes multiple times a week. And we help you with financing. So, you just heard the numbers that Dave quoted earlier, that 800 companies out of which 2 get funded. So if you're one of the 798, then you have to figure out why you're not succeeding in raising money and what do you need to do to, get to the next step. What are your options? Do you have to bootstrap all the way? Do you have an option of following a strategy which will, how to put one foot before the other, basically? And we are very happy to help you with all of that. And when you're ready, we will introduce you to our network of investors. We work with hundreds of investors. We have very good relationships with all these investors. They all look at our deals when we send them deals, but we don't send them. If we have 800 deals, we're not going to send 800 deals to the investors. We're going to send them those 2 or 3 that are curated deals, and that's why they look at our companies. And then we have a lot of clout in the media. We can help get the word out about your business. What I recommend you do is go to the 1M1M self-assessment on the blog, on the webpage, and it's a free questionnaire. It's a strategic planning questionnaire. I did many years of strategy consulting before I started 1Million. These are the questions that I will ask you. These are the questions that investors will ask you, and these are the questions that you should ask yourself. If you get stuck, let's say you see a question, what bottom-up TAM analysis? Well, what is bottom-up TAM analysis? Maybe you don't know what is bottom-up TAM analysis. You can use the curriculum, we have every single methodology points covered in the curriculum. So that's just that's 1M basic. It's our curriculum-only option, online only. You can study at your own time as you need. $99 a month. You can subscribe for a month. You can subscribe for 24 months. It's up to you, whatever you need to do. And we have companies who have just done 1M basic and done very excellent progress just by doing that. So whatever is your comfortable learning mode, use that. There are resources galore on this. Around us, on our site, around us, there's tons of resources. Use them, dig around on the website, understand what to expect from premium, what to expect from basic. There are video FAQs. There's lots of descriptions of the curriculum. The entire curriculum is case study based. We have over 1,000 successful entrepreneur case studies, over 100 unicorns, somewhere around 400 plus venture funded companies, another 400 plus bootstrap companies. So we have looked at entrepreneurship success strategies from many different angles, and it's all here. And that network of people who have helped us create these case studies are all around the program. Our methodology is lean, capital-efficient bootstrap startups. Our philosophy is bootstrap first, raise money later, or not at all. You can go straight from bootstrapping to exit. That's fine. You can raise a small amount of money and go to exit. So all that is fine. All those permutations are considered success in our program. So that's it. We have 2 more free roundtables this month in March, and then April, May, we have full schedules, full rosters of weekly roundtables. We also meet every week, not every week, maybe every week or every other week, sometimes every week, sometimes every other week, usually on Wednesdays at Cafe Boroni in Menlo Park. So if you're in the Bay Area, if you're visiting the Bay Area for a conference or something, or just for business, stop by and happy to meet in person and talk more about your business. These are, very informal, very cozy, friendly sessions where you can network as well as come talk to me. And we will again there's 1 more in March, and then there are more coming soon. So we are back to Q&A. Anybody has more questions is welcome to start asking questions by dialing in or in public chat. We'll start picking up questions in public chat as well. Meanwhile, let me introduce you to Irina Patterson, who is on our team and will be happy to answer any questions you might have about the 1M program. All right. Questions, okay, folks?
I'm going to have to drop off in about 2 minutes, so just to let you know.
We are concluding in 2 minutes. Dave, thank you for staying, by the way. I know you were supposed to leave at 9 and you stayed, so you must have enjoyed it.
Yeah, I had my meeting got pushed back, so the person I'm meeting with was late, so it was
Where are you based, by the way? Are you in the valley or are you in the city?
I'm in San Francisco. Yeah.
Okay. Well, let's get together sometime.
Yeah, definitely. Let's definitely do it.
We'll schedule offline. Folks, if you don't have questions, we're going to adjourn the session. We've already had Ajay, you seem to have a question. What are your thoughts on solopreneurs without co-founders, one founder with part-time support from paid consultants? I personally have no problems. We have lots of solopreneurs. They're doing just fine. We have great case studies of solopreneurs who have done very well. If you go to the 1Mby1M blog and do a search on solopreneurs, you'll see great case studies. One of my favorites is Fine Art America. That guy, as a solopreneur with a bit of, outsourced consulting help, bootstrapped to 5 million, and I think with a very small number of people, he has gone to something like 25 million. And there we have many case studies of solopreneurs having done very well. I know accelerators tend to not like solopreneurs, but I personally have absolutely no problem with solopreneurs. And we have the other trend that is rampant right now is virtual companies. Companies are scaling at huge, numbers with the virtual company model. So we are doing a virtual company ourselves. We have team members all over the world. And you can do a solopreneur with a virtual company with lots of outsourced resources, and you can have 140 people working for you around the world and as a solopreneur, no problem. Dave, do you have any comments on that?
Yeah. I mean, I think it's you can definitely build a successful business as a solo entrepreneur. It is a little harder to get funded, I will say. Like, so when we look at companies, you know, that's an extra risk point that we take into account. So I'd say the traction bar that you have to be at is a little higher. Sometimes the valuation we do is a little lower, and it's basically just actuarial risk on our part. So if we find a team of 3 people and one of their spouses or parents gets really ill and they have to go take care of them for 6 months, it doesn't blow up the company. If you're a single founder and that happens, it does if it's early on in the company's life cycle. So it's just an extra risk point, but it doesn't mean we won't do it. And it looks like I have to hop off. I'm getting a note that my meeting's here. It's great to talk to you.
All right, great speaking with you. Thank you for coming. Gina, your question is you'd like to hear more about the state of freemium model at this time. So freemium has less than 1% conversion rate from free to premium. And if you get to 4% conversion rates, it's considered extraordinary levels of conversion. So keep that in mind when you're building your financial models. Okay, folks, we are beyond the 9:30 a.m. point. So I would like to adjourn for today. Please come back. We'll continue the conversation. And if you are interested in the program, just sign up and we'll start working with you within the program. Thank you very much for coming, and I hope you enjoyed the session. Bye-bye.